Okay, everyone, welcome. We're here today to cover valuing illiquid level 3 investments. An exciting topic that we have here for you. We've got some good panelists besides the two auditors that are on the call. Zainab, can you go next one? Thank you. So, first of all, we got to cover some housekeeping items. This will qualify for CPE. We are NASBA registered. Please make sure that you're on the call for at least 50 minutes and you answer, I think it's 3 out of the 4. You might as well just answer all 4 of the polling questions that come through, and we will send you a CPE certificate. This slide is telling us it's a basic program. There was no prerequisites and no advanced preparation. That includes your presenters. We didn't have any advanced preparation, so bear with us. No, I'm kidding. I'll introduce myself quickly. I'm Tom Stranger. I'm a member or a partner in the audit department of ACRM. We provide audit and tax services primarily to the alternative investment industry. We also provide some fund accounting as well as family office services. I won't spend a lot of time on us. Hopefully you'll know us if you're on our webinar. Will you let the next guest introduce yourself? Michael, do you want to go? Talk about yourself a little bit.
I'm Mike Moscarelli. I'm a vice president with Houlihan Capital. We're a full service valuation firm and investment bank. We do everything from portfolio valuations, which is kind of our bread and butter, to purchase price allocations, fairness and solvency opinions, gifted estate valuations for tax purposes, the whole slate of valuation services. So happy to be on the panel.
Like to go, Lynn?
Yeah. Absolutely. Nice to meet you all. I am a managing director with Kroll in our financial services compliance and regulatory practice. So I will be speaking today a little bit about SEC and other regulatory expectations in this particular area. I've been working in compliance consulting for, oh gosh, I'm going to date myself, a little over 25 years now. So looking forward to the panel.
Yeah, so as Tom mentioned, me and Tom are from the same firm, Ackerman Associates, which he well mentioned about the firm and expertise. And I am the senior audit manager there. So looking forward to the panel and this webinar. Yeah.
Little introduction. Here's kind of what we plan to go through. If you have questions, please post them. We will answer them. Hopefully most of them. I know we might have a lot of questions coming in today. This is a topic that's important from a regulatory and from a evaluation standpoint. We're going to cover some regulatory expectations, which cover fiduciary obligations, regulatory risks, some compliance controls, and probably one of the most important parts of this topic would be recent regulatory enforcement. I think people should be aware of what's currently happening and where the eyes are looking. And then we'll go into valuation practices. Dowd and I will spend a little bit of time on the accounting for hard to value investments and just kind of an overall summary to get everybody up to speed. And then Mike will cover some valuation concerns in the current market and some best practices and changes in the valuations as well. So Lynn, I'll turn this over to you and let you cover some of the regulatory items. I'm sure there'll be a lot of people chiming in with questions as you go through.
Sounds good. So effectively, valuation, while it's not much covered in the Investment Advisors Act itself, where the obligations to ensure that you have the appropriate valuations come out of what the SEC as defined as part of the fiduciary duty of investment managers. So as a registered investment advisor, you have a fiduciary obligation to always act in the best interests of clients. And part of that is to ensure that you are properly and fairly valuing the investments that, in which you are investing their money. There's been a number of SEC releases, risk guidance talking about the need for transparent and robust valuation practices, and this is only continuing. So if you looked at the SEC examination priorities for fiscal year 2024-2025. You know, one of the highlights there is around commercial real estate assets and properly valuing those assets. And it's interesting because it's the first time that we've seen the SEC call out a particular asset class. But, you know, recent statements along have talked about, you know, particularly with regard to level 3 assets. So this is something that is of utmost importance to the SEC. So we need to ensure that we all have the appropriate controls in place and are fulfilling it. So when the SEC comes in, or any of your other state regulators, they're going to be looking at your valuation practices and looking for some key risks, which we have listed in these bullet points here. Effectively, if we don't have correct values, then they can lead to misinformed investment decisions. In a lot of cases, the fees that investors or clients are paying are based on the value of the underlying assets. When new investors are coming in or investors are leaving, we could end up with situations in which redeeming investors or newly subscribing investors are not getting the appropriate pricing, and so therefore they're being disadvantaged either in their redemption or their subscription. And then there's also a lot of potential conflicts in this area. So, you know, we know what happens when people don't necessarily like their numbers. They're going to work hard to change them. And, you know, there's always that conflict there where we want to have and ensure that we've got proper controls around the process, so that the same people who don't benefit from the valuations being obtained are not in charge of determining what those valuations are. So key compliance controls, everyone should keep in mind that this is something that should be done at your firm on a reasonable basis. So if you're a small firm and there's only, you know, 3 or 4 people, having a valuation committee may not be something that's entirely necessary. If you are a large firm, I would say having a valuation committee or some type of other governance committee that's responsible for this is really best practices and pretty much expected by the regulator. But as we go through, you know, keep in mind that you want to do what's right for your firm and what's reasonable, and you want to resist the urge to perhaps put in over controls, which then can lead to easy foot faults if you're not actually following them. So the first thing really is to understand that your policies and your procedures should reflect what it is you're doing. That is like the #1 thing that we find wrong when we conduct mock audits. When the SEC comes in, someone will write a policy or a procedure. At some point down the line, they might change how they do it for very good reasons, and they don't necessarily update their regulatory compliance manual. And that is an automatic give me for the SEC or the regulatory examiners. So you want to make sure that your policies and procedures accurately outline the process that you are undertaking. And you want to make sure too that your methodologies are solid. That's another thing that we've seen where circumstances happen to an investment and the methodology that you were using may no longer be the right methodology, and you may need to change that. But somehow it doesn't get documented that it was changed and what those rational reasons were. And so the SEC is obviously highly suspect if there's various methodologies being used to value investments over time. So you just want to keep in mind, these are living documents and they should at any given point in time reflect your actual practices. And that's the easiest way to get in trouble with the SEC when they're looking at your valuation. Regulatory enforcement actions, these are always coming down the line. So some of the things that get particularly concerned about is looking at valuations and liquidity. So when, we're dealing with level 1 assets, those are fairly liquid, no problems there. If you get into level 3 assets, or if you are having to change your levels, as sometimes happens, you may have something that's a level 1 that gets subject to a trading halt, or perhaps there's a scandal associated. And so now all of a sudden, that asset is no longer a level 1, it's a level 3. Looking at those kinds of mismatches and valuations can create real difficulties with regard to your disclosure and also with the representations that you're making. So in this particular case, this was around the SPDR SSGA Apollo public and private credit ETF, and it had some exposures to private credit, but looking at the liquidity and the valuation processes, the SEC found that they were well above what registered funds could really tolerate. So, those are the things that you need to keep in mind when you're looking at your valuation processes, and also when you're looking at your products. You want to make sure that, the difficulty in valuing your assets and how liquid they are matches up to the needs of whatever your subscription and redemption processes are, particularly in a retail space.
So Lynn, before you jump on, and we have a polling question after this, couple questions. So I think you were
Sure.
mentioning that the SEC, like they're looking at, correct valuation. So as an accountant and an auditor, when we do financial statements, sometimes we like to see conservatism, right? So if they're valuing low, sometimes we would consider that good, or they're going to take a conservative write-off. But it sounds like you're saying with the SEC, they're looking, yes, if someone new came in, that's good. But if someone is redeeming, that may not be good because they're not, if they're allowing redemptions. So I guess conservatism is not necessarily what they're looking for. They're looking for close to accuracy. Is that what we're saying?
Exactly. Yeah. So the SEC's focus is on fair market value. And what they're looking for with fair market value is effectively what two people under no duress in the market would agree to transact at what level. So obviously there's, when you have individual assets, they may not have the same exact set of characteristics. And oftentimes it's hard to determine what the fair market value is in the absence of a transaction. But the SEC's point of view is that you should be valuing as close as you can get to what you think a willing buyer and a willing seller would transact for that asset at that point in time.
Okay. And then you mentioned in the commercial real estate, what are some of the pitfalls they're having in commercial real estate now? Are they not getting appraisals, or, they're using comparables that aren't comparable? What's going on with commercial real estate?
Yeah, I think, coming off of the pandemic, we all saw there was a lot of closing up of shops. People got used to a hybrid working environment, and investments that may have been made years before the pandemic. All of a sudden, those, valuations were not looking too attractive. And as we mentioned, there's sticking to a particular valuation style. For example, if a building is 100% let with a waiting list, you may need to reconsider that if we're looking at 50% vacancies, 60% vacancies, with no real indication on the horizon that that's going to change. So I think, the looking at the markets and looking at the various transactions, the SEC's main concern there is that a lot of commercial real estate holders have found themselves, through no fault of their own, a little bit upside down as a result of the change in Americans' working behavior. And so, when assets change values to the to the negative, that obviously impacts fees, performance fees. It can create losses. And so there's an increased incentive to maybe be a little bit more positive about things than you really should be. Or, maybe not to value things maybe as frequently as you should. So, if you've got a value that that you really like and maybe the new numbers are not so good, then we don't really want to hear about the new numbers. And so I think that kind of stale data, those are the things that they're particularly looking at.
Great, thank you. All right, I guess we'll move on to polling question 1. Please note you're not getting graded, but make sure you answer the question. Which of the following is a potential risk arising from inaccurate valuations in investment funds? Okay, hopefully everybody got through that question. I think when it scanned through, I think the answer was B. I think we just talked about that. I kind of refreshed that with Lynn as a follow-up question. The risk of investors coming in at over or under or leaving at the wrong prices. It's really looking at it from an investor standpoint and protecting their interests. All right, so I'm going to cover quickly some valuation practices, at least from an accounting standpoint. I don't want to spend too long on it because I'm sure everybody will fall asleep following the accounting standards on fair value. Lynn did it off the cuff here pretty well. I mean, in terms of fair value from an accounting standpoint, it's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date, right? So she said, not something that's under duress. Somebody has to dump it and somebody's willing to scoop in and take it for a price. It's willing participants, and it's not between affiliates. I've, dealt in places where you had to do some fair value in between funds because are they going to transfer it between themselves from one fund to another fund with different investors at fair value? They're not going to try to advantage or disadvantage. So, the standard talks about it being an exit price, not an entry price. That's why it was received to sell or to transfer. And it's based on, it's a market-based method. It's not entity specific. It's something we have to look at the whole market to determine the fair value as we do our reporting, and assumes a principal market. So, like I said, or alternatively an advantageous market, right? So you want to get the right value, but some are traded on multiple markets or exchanges. So you might find something has 2 million units traded on one and 5 on the other, right? And that other market might have a better price, but you really should consider where are you most likely to trade this security and where are you going to get the true fair value out of it? Is it between the 5 units over here on this market, or is it over here with the 2 million units on another market? So that's what that's looking for. And then there's a fair value, the hierarchy is based on 1, 2, or 3, which is, really based on the inputs, which I'll cover quickly in the next slide. So here you have the fair value hierarchy, right? And it's divided into 3 levels of inputs. I think we're here to focus today on level 3, but just to, refresh everybody on level 1, these are quoted or unadjusted prices in active markets for identical assets or liabilities where the reporting entity has the ability to access these markets for a potential transaction as a measurement date. So what are we looking at here? Things on the New York Stock Exchange, NASDAQ, anywhere where we can get a quick quoted price. Level 2 is where the inputs are observable, either directly or indirectly. And this is a case where you might have some kind of derivative contract based on the value of something else. So you're really going to have to go and look through to that underlying security, but there's not a marketable price for it and you have to adjust it. And level 3 is the one we're talking about now, which, it used to scare a lot of people, but you don't have any observable inputs. There's no real market for these securities. Somebody's going to have to determine that valuation when these observable inputs are not available. So I'll let Dowd, he's probably going to talk a little bit more about these, but this is where we're going to spend our time. And if we don't have any market values or prices, what do we do? You know, what does the valuation people do? And then what do we do as auditors to try to test something that doesn't have, you know, observable inputs? That's what accountants do. We like to observe something. So hopefully this will help everybody understand where we come from as auditors, as well as the valuation experts.
Thanks, Tom. You briefly mentioned the fair value hierarchy, but I'll go some sort of into a deep dive into each level so that the viewers understand each level perfectly. And then, you know, Michael goes with the flow for valuation practices until level 3. So let's start with level 1 practice. This is what we often call mark to market. The idea is straightforward. If the market is giving you a price, you use it. Basically, ASC 820, which is the fair value standard, tell us that positions must be marked to market, meaning you cannot just carry them as cost or some at impaired value. You need to update them on the balance sheet to reflect the fair market value at the measurement date. And if there is an active market price available, that's your starting point. Here are some things about level 1. The first one is what qualifies as level 1. So level 1 means you have got unadjusted quoted prices from the exchange. For example, if you own 100,000 shares of Tesla, you look at the price on Nasdaq. That is your fair value. No adjustments, no discounts. Even if your position size is large compared to the trading volume on Nasdaq. That is a very important point, because ASC 820 specifically prohibits us that applying a blockage discount just because you have a big holding on that portfolio is not allowed, basically. And here is a very crucial detail about this one is that if you start adjusting the quoted prices, for example, to account for any market impact or some internal assumptions, you have left the level 1 territory. That's when the asset of level 2 hierarchy moves in, because the input is no longer purely observable. So this is a very crucial point. Another point is that when you are valuing long positions, bid quotes are preferred because fair value is based on the exit price, as Tom mentioned, what you will be receiving if you sold the asset right now. So level 1 is simple and clean and transparent, but as soon as you introduce the adjustments on the quoted prices, you are stepping into the lower levels of hierarchy, which is level 2. Moving towards level 2. Yeah, level 2 is, you know, what I call the middle ground. We still rely on market data, but it's not as clean and direct as level 1. What level 2 really means is that they are market observable inputs, but they are not perfect matches. Fine. Think of quoted price from similar assets in active markets. For example, if you are valuing a municipal bond that's not traded daily, you might use the price of another bond with a similar maturity and credit quality as your benchmark. So that's where, you know, level 2 comes in. Also, broker quotes can be level 2, but there is a condition. You have to be reasonably confident you can actually execute a trade at that quoted price. Ideally, you should take more than 1 or 2 independent quotes to confirm that it's reliable. Another thing is that if you have an identical or similar asset, but it's in the inactive market, meaning the trades are infrequent or less, you can still use that data. But unlike level 1, a blockage discount, which ASC 820 prohibits to use in level 1, you can now use to make it more appropriate. Then if you use a model at level 2 stage, it should be widely accepted, non-proprietary approach, and all the data going into that should be from observable from the market. The moment you start using unobservable assumptions, you slide into now the level 3 territory. So level 2 is still grounded on market evidence, but it is one step removed from the you can say pure unadjusted prices as level 1. Moving towards level 3. Yeah. So this is where the market is giving at least some data to work with. But what happens, just like we have in level 1 and level 2, market is giving some sort of data. But what happens when the market is silent? That's when we step into level 3, the area of Mark II model. Level 3 is basically driven by unobservable inputs. This means we are building the valuation using assumptions the market is not directly giving us, like the required rate of returns, pricing multiples, or fair yields. Essentially, we are making informed estimates, based on what we believe the market participant would think. To do that, we rely on models. For example, the Black-Scholes models for options, discounted cash flow models for businesses, and much more, which Michael will share us in a while. And basically, here, the reliability of the valuation is only as strong as the quality of your assumptions and the transparency of your methodology. So this is the key thing in level 3. Interestingly, level 3 can even include public listed securities if they have a very little trading activity. So just because something is publicly listed on the exchange does not automatically, give them a leverage that it is a level 1. So you need to make sure that whatever the guidelines and things standard mentions for level 1 should be, met to classify at that level. Another defining feature for a level 3 is that it reflects the entity's own data, right? Their forecast, their business plans, and internal metrics. But it should be framed as if a market participant were making the valuation. In other words, you put yourself in the market shoes. And one more key point is that ASC 820 does not allow, specifically does not allow to ignore readily available information for the auditors, as long as it is obtaining without any, undue cost or effort. So while level 3 is heavy judgment, we all know about that, but it is not a free pass to skip the market research for auditors. So, and that is why most illiquid investments like private equity stakes fall into level 3, and we don't have the luxury of a market code. So we build value through models supported by the best data we can find over the internet. The challenge and the art is ensuring those models are both defensible and aligned with how the market would think. So this is primarily, level 3.
Here's your buzz warning. Another polling question. Everybody can wake up from our auditing talk to answer the current question. When under ASC 820 do level 2 inputs generally become level 3 assets? Okay, hopefully, if you made your answer, you picked A, when significant adjustments are made to level 2 inputs. So if you make too many, you take it out of level 2 and put it into level 3. So I think we're going to move on now to Michael, who's going to walk us through all these complex level 3 market value determinations and hopefully educate us a little bit so we understand, as auditors and fund managers, whoever else, what are the different approaches and how do we apply them and what do they mean?
Yep, for sure. Thanks, Tom. So as you can kind of see, there's 3 really key primary approaches that we take in valuing level 3 investments. There's a variety of approaches and methodologies underneath each of those, but those 3 there are kind of the overview. So to give you a sense, market approach is usually what you'll see, I would say 75% of the time, pretty frequent. This is a couple of different approaches. You can use comparable company market multiples. We refer to this as like a guideline public company method, right? So you go out in the market, you look at the whole universe of public companies, You compare some of their valuation metrics. Typically, you see things like enterprise value to revenue, enterprise value to EBITDA. You might see price to book in certain situations, as mentioned here. And then you use those multiples to inform the value of the company that you're valuing. That one's used fairly frequently, particularly for earlier stage investments, things in venture capital. We typically look to public company market multiples and make that comparison. In a similar vein, you can use comparable transactions. These are usually controlling stakes. You probably won't see this quite as frequently. Two real reasons for that. One is that comparability is very difficult. Taking a transaction done even 6 months, 9 months ago can be difficult to make the leap that that's a comparable transaction. There's a variety of factors in any transaction that would be difficult to consider when selecting multiples derived from these transactions. And then on top of that, as you're all very familiar, private transactions typically have no obligation to disclose valuation metrics. Things like historical revenue, you might get a headline valuation number, this transaction happened at a 400 million valuation, but for the purposes of something audit supportable, that's kind of not enough. So typically you'll be able to find plenty of things out in the universe of transactions you can make the argument for being comparable, but the level of data availability is going to be very difficult. And there are platforms out there that we can sometimes leverage, but in general, it's tough to find pure play comparable transactions in sufficient quality to use them. You'll see prior transaction approaches. That is fairly frequent, again, in venture capital, where you have consistent rounds happening every year and a half, 2 years. You can point to those transactions. It's important to understand that you can't always utilize those. There are detailed considerations. You should think about things like, is this transaction third party? Are these investors previously affiliated with the firm? Are they already on the cap table and they're investing in this new round? There's no outside third parties investing. And then size as well. If it's a $50 million, $100 million firm and someone's investing 50K onto the cap table, it's going to be difficult to make the argument that that's a valid valuation input. But we do see this fairly frequently because, again, you're having consistent rounds. It helps calibrate other approaches that you may use in the interim. And you'll sometimes see a prior transaction that's adjusted using some of these market metrics in kind of a calibration approach that kind of blends prior transaction and a few other market indications. So we do like to anchor to those when they're available. And then a firm offer, or you might hear like a pending offer is sometimes used as the terminology. This is difficult to evidence. Many valuation firms have gotten burned here using a transaction that had a term sheet but no signed LOI, non-committal investor, right? So you want to make sure if you're going to use this approach, there's a very, very strong indication that it will close, that it is closed. If not, you'll sometimes see a probabilistic approach where you say, well, management estimates there's a 25% chance that this thing will close, but if it doesn't, here's what the firm looks like from another valuation approach, and you can weight those probabilistically. And that's kind of a way to cover your bases and not get caught marking to a transaction that never ends up closing. And as anyone in the deal space knows, transactions can drag, they can get canceled for the smallest and most mundane of reasons. So you typically really, really need to evidence that, especially if it's your only approach. So moving on from there, you have income approaches. Discounted cash flow, you see fairly frequently. This is, again, difficult. We talked about information availability. You need a pretty robust forecast, typically from company management, to do this approach properly and evidence it. There are certain market participant assumptions that a valuation specialist can make, but for the most part, you do really need pretty complex reporting structure from the underlying company. They need to have this information available. So you see it less frequently, partially on an information availability standpoint, and also because it can be difficult to apply to really, really high growth companies. When a firm applies this approach, they have to select a discount rate that's appropriate, that considers the level of risk in a forecast, and we'll touch on this later, but If it's a very aggressive forecast, typically there has to be a commensurate discount rate. And that can make it difficult for high growth early stage companies to be really compatible with this approach when the market's telling you something kind of completely different. And then capitalization of earnings really is typically applied for very steady state, constant rate of growth companies. You'll see this as well. We mentioned commercial real estate. If you have a cash flowing asset that's at a certain level of occupancy and it's going to expected to do that consistently, you may see this approach applied. It's a little old school. It's tough to maneuver around if something material happens. So we see it used selectively, and there are situations where it's appropriate. But as we mentioned, like in CRE right now, things change, occupancy rates change. So you have to be careful relying on such a strict presumption that things will continue on as they are. And then there's cost approaches. There's a variety of ways to apply this. You might see an asset-based approach that takes sort of the book value of the company's equity and adjust it to being a market value. You'll see that. You'll see replacement costs or cost to recreate. You may see that in, say, the biotech space, where you've spent whatever amounts on R&D, and that's the primary asset of the company is some sort of developed drug candidate that's you've spent X amount on, and that's a good way to corroborate the value. So a variety of cost approaches can also be applicable. And again, important to note, these are all situational. It's all based on information availability. Typically, you'll see disclaimer language that there's no one approach that is stronger than the other. It is really all about how you can build the argument and make it audit supportable. And yes, so talked about a couple considerations. There's quite a few things to think about. This is just a brief overview. We can talk questions. I could talk about this all day long, but I'll keep it surface level here. So a couple of key things. As we mentioned, that level 1 through level 3, sources of prices are very important. You need to be able to evidence them. It's important too to consider if those prices are repeatable. You know, if you're looking at these valuation methodologies on a consistent basis at whatever reporting date, you want to make sure that you can find that price when it comes around. So you want to make sure that that is part of your consideration. Again, priority of sources, you should understand that fair value hierarchy. If you have a level 1 input that can value what you're looking at, you should use it. All the guidance will tell you that level 1 is what you have to use rather than level 3 if you have a level 1 available that's supportable. And of course, how those sources are used, sort of self-explanatory there. Methodologies, again, what they should capture. We mentioned readily available quotes. It's important to understand the source of those still. It's tempting to take a quote on an exchange at fair value or at face value, but you do want to understand things like volume. You want to understand exactly what is being quoted on the exchange. We've seen that where you might have an ADR quoted and it's a different sort of share ratio for the underlying shares, and you might hold underlying shares, things like that. You want to make sure you really understand what you're looking at. Broker quotes, you want to make sure it's committed, that they would transact at the price that they're giving you, or someone would transact at the price they're giving you, kind of similar to that pending transaction thing we mentioned. You want to make sure it's committed. You don't want to have a scenario where the price is sort of wishy-washy, and again, repeatable. If you can get a broker quote one quarter, you want to hope that you can get it every quarter from there on, so you can keep your methodologies consistent. Third-party pricing services, there's a broad universe of them, a couple of, Capital IQ, Bloomberg, all of those. You want to make sure your valuation specialist or your team has access to those. You don't want to miss anything that your auditor may be obligated to then go and look at. Can cause some confusion there for sure. On level 3, of course, proprietary pricing models. You will typically be using a lot of these. It's a value level 3, of course. So you want to make sure you're covering all your bases there. And then you want to understand the original cost of the investment. Benchmarking, understanding how the value of assets is changing over time is very, very important. It's key. Your auditors, as well as any regulatory bodies, are going to be looking at how values change, not just what a value is at any given quarter or any given year end. So you want to understand that original cost and how you're varying from that. And then best practices. This is wide spanning. Again, I'll try not to talk your ear off here. Obviously, compliance with guidance, ASC 820, IFRS 13. These are just the sacred book of any valuation specialist. You want to apply guidance from the PEVC. We'll refer to it as the cheap stock guide. It's kind of a dated to refer to it that way, but you'll hear that thrown around. There's lots of guidance out there. This is one of the ones that's used most primarily, especially for venture capital, private equity portfolios. You want to, of course, maximize observable market inputs. We've already covered that ad infinitum, and we'll continue to do so. Again, on the calibration component, you want to understand how things are changing over time. If you get another transaction that comes in, you want to make sure you're adjusting to everything out there in the marketplace. You want to make sure that you use what we would say known and knowable at the time of the valuation. So you really don't want to discard any information. Anything you learn about the investment in that time frame really should be included, even if you don't rely on it strongly, even if it's not the one thing that changes your value. You want to make sure you cover the whole universe of information. Valuation methodologies should be used together if at all possible. The conceptual idea is that they would all produce a similar value if they're being applied correctly. This is not always the case with things like high growth companies. It can cause some rift between them, but where possible, where the information exists, you do want to apply multiple methodologies and then typically weight them equally, assuming that no methodology is inherently better than the other, though again, the quality of the inputs you're using for them can change those assumptions a little bit. Maintaining internal consistency, you should have a valuation policy. You should follow the valuation policy. And then if you deviate from it, you want to make sure you're documenting why, right? If you use one valuation methodology at the end of the year and then the next quarter comes around and you go, this has changed, we need to use a different methodology to appropriately value this, you want to make sure you're documenting why. Because at the end of the year, you go through an audit process, they're going to see how things have been marked historically, and people are going to want to understand where that change is coming from, which leads right into ensuring robust documentation, audit trails for all valuations. You just kind of want to save everything. And then, of course, toot our own horn, we would recommend engaging a third-party valuation specialist when complexity or materiality warrants it. Things like complex capital structures can really make it difficult to clear an audit process with your existing approach and your existing team. And then materiality as well. If it's the crown jewel of your portfolio, it's particularly important that it is valued appropriately. It has a material impact on the investors entering and exiting, an outsized impact. So it's important to have an independent review and also someone who will help communicate that valuation to relevant parties, right? A third-party valuation specialist can speak directly with auditors. They can speak their language, and they can help understand the way you've approached the valuation. And of course, aligning with regulatory expectations, investor transparency, that is all key and all, of course, something that should be followed.
We got another good polling question. When valuing an investment, which guideline emphasizes maximizing the use of observable inputs? Okay, hopefully everybody selected the first one. We talked about that quite a bit. There you go.
Yeah, happy to talk about a few challenges, get the methodology stuff out of the way. What are we seeing right now? What is difficult about doing valuations? There are many things. And some of the reasons you might both look to a third party, but also if you're engaging a third party, some questions that are important to ask them to understand before you choose a partner to work with. Of course, volatility between measurement periods, this will continue on. It's particularly relevant in the last few years. I mean, you have something like COVID completely disrupting markets. So it just generally good measure, good reason to do consistent valuations. Inflation and rising costs. This affects the underlying operating companies. So when you're valuing an interest in said company, this is something to consider. As I mentioned, aggressive forecasts. We saw a lot of this in the heydays of 21, 22. A lot of aggressive forecasting going on. It's important to understand both where that forecast is coming from, how well it can be supported, and then understanding too, in a valuation context, where is the risk of that aggressive forecast being offset, right? So you want to make sure any valuation specialist you're working with, they're not engaged to audit a forecast, but they should understand the components of it. They should, if possible, speak with management, understand the inputs, and make sure they can appropriately value that underlying asset. Limitations on available data. We see this particularly in VC and PE. You may not have full information rights. And on top of that, you may have some companies where their financial reporting apparatus is not fully built out, or it's not a priority. They're focused on building a product, and they don't have a lot of time to give you 5- and 10-year forecasts every quarter. So it's important to work with someone who understands these limitations, is familiar with them, and can also understand the limitations of assumptions where information is not available. You don't want to be kind of guessing at your inputs. You want to understand what is supportable and what is not when that information is not available from the underlying company. And then someone who, again, knows how to speak the language of auditors. You may disagree with them. You'll have this discussion with them frequently. You really do want to, they are an independent specialist. You do want it to be a collaborative process, right? They should understand where you're coming from. You should understand where they're coming from. If something seems off or you don't understand evaluation, you should never hesitate. You should never feel like you're a bother to talk to your independent valuation specialist. You should understand those. And your specialist should be able to answer the questions of auditors, right? It may or may not be priced in as part of an engagement, but it should be something where they are able to articulate what their valuation is. They can support all of their inputs. They can show the sources of those inputs where available. You should make sure they're familiar with the audit process and can handle it on your behalf to some degree. So a couple of key considerations when choosing any specialist you'd work with. Obviously, independence is key. You see this frequently where audit firms will be sort of independence brokered out. If they're engaged in your audit, they frequently can't do the valuations for you. So make sure you understand that. Expertise in asset class and industry. This is, of course, key. Your specialist needs to understand what they're looking at. We see this fairly frequently in our firm's digital assets practice, where it's a hot space, it's growing, and some firms may be tempted to kind of give it a shot and not be super familiar. So you want to make sure if you're an expert in that industry, you're investing in that space. Ask a couple of industry questions, make sure they understand what they're looking at. As we mentioned, experience with auditors, regulators, investors, administrators. Many third-party firms will be willing to tell you who they're working with. They'll be interfacing with these other firms all the time. They'll have experience. They'll be able to speak to it, might be able to point you to other service providers in the space that they are encountering frequently, should you need them. And that's a good sign, right? That means they're doing this work, they're doing it in the space you're looking at, and they're interacting with these folks on a regular basis. Supporting valuation analyses, that's kind of a given. Team capacity is, of course, very important, worth considering, always, always, always worth asking. When you get to the scoping process, you want to understand that they have the time and the people available, especially the specialized people available to meet the needs of what you're valuing. And then resources to access market information. We mentioned there are many platforms out there. You should ask about that, and they should have an answer for you. Things like Bloomberg, Capital IQ, Crunchbase, PitchBook, all these data sources are very key to have an understanding of and be looking to regularly. So there's a lot of other challenges, but those are just a brief overview of some of the ones you might face.
Great, thank you. We're at our end. We have one polling question. We'll see if we have some questions coming in afterwards, or I'll ask a question. Which of the following best reflects the overall best practice in performing valuations under the fair value framework? Okay, hopefully everybody picked the second one. To apply multiple methods, use market inputs, calibrate models, and keep strong documentation. The other ones were, of course, very simple. Do we have any questions out there?
Yes, I'm checking at this moment, so let me.
Okay. So quickly, while Mohammed is checking there, Michael, question. We talked about like finding information from public companies, price to book, for example. How do we look? Do we go out and find one and we're done? Do we pick 10? And then when we get 10, do we do an average? Do we use the one I like the best? What kind of recommendations would you have when looking at market data like that?
Right. Yeah, if say you're searching for like guideline public companies or guideline transactions, you should have, or your valuation specialist, or if you're doing it in-house, you should have a very robust documented process. You might use a built-in screener on any of these platforms. Your screening criteria should be saved. They should be something that an auditor can review. They should understand how you went about your search for comparability. From a company standpoint, things like size, business model, geography, all key considerations. Typically, you want to avoid companies that are current targets of acquisitions, because that can throw things off a little bit. Variety of considerations there, but you want to make sure that process is documented. And that is something that can be explained.
I couldn't see the.
I think we're getting a little background from Mohammed. Do we have any questions coming in, Mohammed?
Yes, they have question. I'm trying how to.
I actually had kind of a question because I had a similar situation come up with a client just recently. So, Dawood, you had mentioned if you have a position and it's trading, I think you specifically talked about Tesla. Even if you have a very large position, you still should take the market data or the market price. I guess, can you maybe shed some light on when you might make the determination that something like that should move to a level 2? Because obviously if you own, let's say, 70% of the outstanding shares, and you roll into the market and try to sell them all at once, the current price is not going to be the price for very long. But understandably under ASC 820, you're not supposed to discount it. So I guess what are and Michael, welcome to your thoughts as well, but what are the things that you consider if you're thinking about moving something that, on its face is clearly a level 1 position, but maybe it's not because of the size that you hold, and maybe you need to think about it from a level 2 perspective?
Yeah, right. So the first indicator, which is the main one, lies within your question, that the holding of someone is very big with respect to the frequent trading on that platform. So for example, if, as I talked about, that someone is holding 100,000 shares of Tesla, and he is going to get the quoted price from the exchange, and the trading volume is very low, then you need to consider, like, you need to move it at level 2, because and secondly, second indicator is that you also need to check that subsequent to your auditing period, that at which amount or at which price those securities are at the selling point. Like, are they sell at the same point which they are at the measurement date, or it is different? If it is way less, then yes, we need to apply discount and move that security to level 2 or level 3 based on the assumptions we face. But these two are the indicators that the data, the trading data or trading volume is very low as compared to the portfolio we are having.
Okay, I have a several questions. Sorry, my bad. I'm just jumping now. So one of the question is here in regards to sanctioned investments like Russian assets that are performing well, paying distributions which are not accessible, and the asset is currently not realizable. What is seen generally as appropriate valuation discount? They're asking valuation discount. So probably I think Michael and Daud can chime in on that question.
Yeah, I'll let you take it first, Dawood. I can chime in after.
Yeah, sure. So in that cases, when we are talking about something is blocked out due to some sanctions, so as an auditors, we need to question the assumptions which the valuation firm or expert has taken, that what is the probability that in the near future those sanctions will remove, because that is a point when we can sell this thing off and get this investment a liquid position. So if there is a high chances that the sanctions will be removing in the near future, then we will take discount, a very little discount. So, but obviously as an auditors, we cannot, quote the discount range. It's the valuation firms or valuation practicing expert can do that. But yes, this is something which I can question, that what are the chances of removing that sanction? And if there are remote chances, then obviously as an auditor, we are moving towards the complete write-off of that investment.
Yeah, I can definitely agree. I think it's, there's probably consideration of whether or not that should be a binary outcome, right? It's what either the quoted price or it's zero. Definitely sort of the more conservative way to view it. You might be able to make the argument for a marketability discount. There are various models, various studies you could look to. Typically that's reserved for more like contractual restrictions on trading rather than something like sanctions. But I think there's probably an argument to be made. It's a little different than like a traditional blockage discount, is as we mentioned, is kind of forbidden under ASC 820.
Okay. Another question is, what is the minimum partner's capital or NAV, net assets value, to set up a valuation committee for any fund according to industry best practices? Lynn, would you like to give your perspective?
I think it really just depends. So we've seen very, very small firms that will have a valuation committee with maybe only 3 people on it. We've seen larger firms where they just have an independent valuation group that's removed from the portfolio management function. And so there's no need to have a committee. So I don't know that it's necessarily an AUM test or a number of employee test, but how it would, work best for your firm. I'll let the gentleman speak from their observations, but I think, probably 80% of our clients have a valuation committee of some type. But again, I don't think that we certainly have plenty of clients who don't. I think the more concerning aspect is ensuring that there's at least enough eyes on it that any one person doesn't have full control. And, certainly as a compliance professional, I'm going to promote the chief compliance officers out there, but we're not valuation experts. The SEC isn't going to argue with your value the majority of the time. What they might take issue with is how you got to it. So I always think it's at least wise, if you don't have a committee, to have your chief compliance officer working with the team that's establishing those values, so that compliance does have at least a view into how the sausage gets made and can represent you to the regulator if that comes up. It's probably not the answer. It's a lot nicer to be able to say, oh, well, at 500 million, you should have a committee. But, really, it's much more important than what you're doing works for your firm and makes sense.
Michael, would you like to chime in?
Yeah, I kind of agree with Lynn there. It's more about documented process than it is about an AUM specific number. You could say anybody should have one, but that's not necessarily practical in all situations. And again, as Lynn points out, it's more important that multiple people are assessing this process, right? It's not just one person marking that, and limiting conflicts of interest is really the goal here.
Yeah, I think Daoju can answer this. How can we determine discount rates for level 3 investments?
Discount rates, that is something, I ask that as an auditor, you always need to test and ask how these inputs are coming from. And this is basically our responsibility, because we cannot just forego that is the part of valuation firms, and they did it. So in order to, it's you can say a judgment thing, and it depends on what we are actually valuing using a DCF method on which we frequently use the discount rates. But there are multiple things like it is also coming from a US treasury rates, a risk-free rate, or that is you can say a average discount rate based upon a certain sector in which the companies lies on. So that comes from different backgrounds. But the thing is that you need to ask and research upon. That is more important as an auditor.
Okay, I think we can take one last question. So already over. I know a couple of people asked the question we couldn't answer, but I will respond via email. But the last question is, how do you handle the calibration of valuation models for level 3 investments in the absence of recent comparable transactions?
I can guess take that one. There's kind of a couple different ways to look at it.
I was like, it's much better to have you do it than me.
Yeah, I mean, you can, if you're, say, and the time frame really varies. It's more based on, what developments have happened to that company since that last transaction, right? You can adopt another valuation methodology. Typically, you might go to, if the information is available, a GPC, a DCF. You might go to a different approach. Otherwise, you might say that info is not available. You have a previous round. You have a few operational updates on the company. You might use more of a calibration method. So you go out into the market and you find a variety of what you would consider to be likely correlated assets. So you might look at the market caps of comparable companies. You might look at some indices. We see, in the digital asset space, we'll sometimes see changes in the values of tokens underlying a company. So it can really depend. That's typically what you'll see if there's no information available for another valuation methodology. But typically our approach is, if the transaction has happened and there's been material change to the company where that transaction is no longer kind of a valid indication of value, you want to look to other approaches in the interim until another transaction presents itself. And that, right now with VC&P exit timelines expanding and rounds taking longer and longer, right? You might be at 24 months between rounds, 36 months. Using other methodologies rather than just considering that round is kind of the way to go. And it's good to calibrate as well. You might look at what you would consider to be comparable movements in the market, using that, trending it from the last round, and then compare that to other methodologies and try to find a midpoint there. So that's typically how we would approach it.
And just adding a few lines what Michael has discussed. Yes, he's right that we will be very happy to see some valuation reports when the valuation expert has performed multiple approaches to make it at point A, and like the primary approach, the secondary approach, and tertiary approach. So that's the best thing we have seen as an auditors. And about the calibration, yes, if the recent market data of that company is not available, then we can also move towards the data for similar companies or similar assets. And also we need to adjust the macroeconomic factors too while calibrating any asset that is related to that specific asset. So if the data is not available to that company, then we can do some sort of calibration of that asset.
Okay, awesome. I think I would, Tom, back to you. However you want to finish it, please.
I want to thank our panelists and I think we're hitting a good time. I don't know if you can hear the thunder in the background here, but I'm getting a major storm coming through here. So we probably ended just in time. So I thank everybody for listening, and be on the lookout for more webinars from us in the near future. Thank you, everyone.
Thank you.
Thanks.
Thanks. Bye.